Okay, so let's start. Want to start this new topic. Our topic is called ratio analysis. Now, we want to ask ourselves, as a company, why do you need to compute some of the ratios of your business? In other words, what are some of the uses of ratios? Okay, one purpose of use of ratios is that as a company, you can use ratios to compare. You can use ratios to compare the performance of different firms which are in the same industry. For example, you are company A. You want to compare your performance with another company, let's call it B, which is in the same industry. So you compute from the financials of company A, compute some ratios, from the financial statements of company B, compute some ratios, then from those ratios, you will be able to compare the two companies. That's one purpose or one use of ratios, is that ratios can be used to compare different firms in the same industry. Those companies which are in the same industry, you can use ratios to compare them. That's one purpose. Number two, another use of ratio is that you can use ratios to compare the performance of a firm, over a period of time. What I mean is this. You as company A, you may want to know in which of the following years did we do better? In which of the following years did we do better? Did we do better in 2022 or we did better in 2023? So you want to compare the performance of the 2 years. So from the financials of 2022, you calculate some ratios. From the financials of 2023, you calculate some ratios. And from the two categories of the two ratios, you will conclude which year you as a company, you did better. So that's another use of ratio, that you can use ratios to compare the performance. This is compare performance of different firms. Compare the performance of a firm over a period of time. To compare the performance of a firm over a period of time. Good. Having said that, now that you know the purpose or the uses of ratios, now we want to talk about how do you calculate some of those ratios. Okay? But before we calculate the ratios, we also need to know that ratios are classified into different categories. We have different categories of ratios, and each of the categories of ratios have their own purpose, So let's discuss first what are the types of ratios, types or categories of ratios. What are the types or categories of ratios? Okay, let me introduce them. One type or one category of ratios is what we call liquidity ratios. We call them liquidity ratios. Another category of ratio is what we call activity stroke asset ratios. Call them activity or asset ratios. Some books will call them efficiency ratios. We shall discuss them in details. Number three, another category of ratio is what we call profitability ratios. That's another category of ratios. Number four, that is another category of ratio. We call it gearing ratios. So that's another category of ratios. That is gearing ratios. Number five, we have what we call shareholders ratios. So these are the different categories of ratios, and each category serves its own purpose. Okay? The category of ratio or the type of ratios normally serve its own purpose. So let's start with the first category, and that's what we are calling liquidity ratios. What are they and what is the purpose? What is the purpose of liquidity ratios? Why do you as a company calculate the liquidity ratios, and what are they? Now, as a company, you may want to know as a company, you may want to know, are we as a company able to pay or to meet the obligation of paying, our current liabilities? Are we able to meet the obligation of paying the current liabilities? Only current liabilities. Are we able to pay our current liabilities as a company? So to know whether you're able to pay your current liabilities or not, then you will be required to calculate what we call liquidity ratios. So they measure, listen, these liquidity ratios measure the ability of a firm in paying its current liabilities. Measure the ability of a firm in paying its current liabilities. Okay? What are some of the liquidity ratios? What are some of the liquidity ratios? One of the liquidity ratios we shall be calculating is what we call current ratio. And to get the current ratio, you take the current assets of the business, you take the current assets of your business, you divide that by what we call current liabilities. Take the current assets of your business, you divide them by current liabilities. That's how we shall be calculating the current ratio. That's how we shall be calculating this ratio. We are calling current ratio. You take the current assets of the business, you divide that by the current liabilities. Now, let us assume, listen, suppose from the financials, the current assets of your business are 200,000. But the current liabilities of your business are, let's say, 100,000. So, tell me, are we as a company able to meet our obligation from the current assets? Are we able, from the current assets, are we able to pay our current liabilities? Yes. You can see that the current assets of your business can be able to cover your current liabilities. That means you can be able to pay. Now, don't forget, listen to this. We are comparing the current liabilities with the current assets. Remember, we are computing the ability of a firm to repay its current liabilities. That is the key purpose. And why then do we compare current liabilities with current assets? It is, of course, obvious. You know, current liabilities are which kind of liabilities? These are liabilities that should be repaid within a short period of time, usually less than a year. Those liabilities that should be repaid within a short period of time, less than a year, those are current liabilities. So you cannot compare current liabilities with long-term assets. You compare the liabilities with the assets that match those liabilities. So the assets that match those liabilities are the current assets. Of course, you know, by definition, current assets are which kind of assets? They are assets that can stay in the business for a short period of time. Listen, current assets are those assets that can stay in the business for a short period of time, and they are easily converted into cash. They can stay in the business for a short period of time, usually less than a year, and they are easily converted into cash. Good. So that's why we are comparing current assets, which can be easily converted into cash within a short period of time, with the current liabilities, which should be repaid within 1 year. Now, when you compute this ratio, like for example here, I have assumed our current assets are 200 and our current liabilities are 100. We normally say the ratio now becomes 2 to 1. The ratio is expressed as 2 to 1. That's how we express the current ratio. We are taking the numerator, which is current assets, you divide by the denominator, which is current liabilities, and whatever answer you get, you express it as this to this. For example, our current assets being twice as much as current liabilities, then our current ratio becomes 2 to 1. Now listen, if you calculate your current ratio and you get your current ratio to be greater than 1, any ratio greater than 1 means what? Any ratio greater than 1 means that the firm is able to pay. Any ratio greater than 1 means that the firm is able to pay its current liabilities. The firm is able to pay its current liabilities. Like, for example, our current assets are 200, while current liabilities were 100. So our current assets are covering current liabilities twice. That's a ratio which is greater than 1. So in that case, say the firm is able to pay its current liabilities. Any ratio less than 1 means, any ratio less than 1 means what? For example, suppose your current assets are 100,000 while your current liabilities are 200,000. So you will get a ratio which is 0.5 to 1. 0.5 to 1. In other words, our current assets are half as much as our current liabilities. So in this case, you are not able to pay your current liabilities from your current assets. You as a company, you are not able to pay. So we say if the ratio is less than 1, then the firm is unable to pay its current liabilities. The firm is unable to pay its current liabilities. So we normally say that if the ratio is greater than 1, then the firm is able to pay its current liabilities. Then any ratio less than 1 means that the firm is unable to pay its current liabilities. Now listen, another key important point. The recommended ratio, the recommended or the standard ratio or current ratio is usually taken to be 2:1. That is the recommended. The standard ratio should be 2:1, in the sense that your current assets should always be twice as much as your current liabilities. That is always the recommended ratio. Okay? Now, listen. The question is, what if you have a ratio of 5:1? Is there a problem? Maybe your current assets are 500,000 while your current liabilities are 100,000. So you get a ratio of 5:1. Is there a problem? Listen to this now. One conclusion you will make is that you as a firm, you're able to pay your current liabilities. That's one conclusion, of course, because the ratio is greater than 1. But knowing the fact that your standard or the recommended ratio should be 2:1, knowing that your standard ratio should be 2:1, then where you get a ratio greater than 2:1, listen, any ratio greater than 2:1 means what? Means that this firm is holding, listen, this firm is holding too much funds in current assets. The firm is said to be holding too much funds in current assets. For example, it could be what makes your current assets 500 compared to current liabilities 100. It could be maybe you have too much money in the bank or in cash. Remember, they are part of current assets. When you have too much money in the bank or too much money in cash, then we say, listen, we are holding too much funds in current assets. Listen, those funds could be invested elsewhere by a business. The funds could be invested elsewhere to generate profit. Instead of keeping your money idle in the bank or in hand, cash in hand, why don't you invest it elsewhere to generate profit? To generate profit. That's why we normally say any ratio greater than 2:1 means what? That the firm is holding too much funds in current assets. Those funds could be invested elsewhere to generate what? Generate profit. Good. That's one of the liquidity ratios. We are calling it current ratio. You there? Good. We now go to number 2. We now go to number 2 type of ratio under liquidity ratio. And that's a ratio we call acid test. We call it acid test ratio. Call it acid test ratio. Some books will call it quick ratio. Some books will call it quick ratio. How do you get it? To get the quick ratio, you normally take your current assets, and you minus stocks, and you divide that by current liabilities. You get the quick ratio by taking current assets, you minus stocks, and you divide that by current liabilities. Now listen. Why do we take current assets and minus stocks? In other words, why do we minus stocks? I have told you what is a liquidity ratio. These are ratios that measure the ability of a firm to repay its current liabilities. Okay? What are current liabilities? These are liabilities that should be paid within a short period of time, usually less than 1 year. Now, but you may realize that there are some stocks that can stay. Listen, you may realize that there are some stocks that can stay in the business for more than 1 year before they are sold. In some businesses, some stocks can take more than a year before they are sold. Therefore, listen, to get a more clear picture, as to whether your company is able to pay the current liabilities or not, then we are saying calculate the liquid assets. Meaning, take your current assets, you minus stocks. Once you minus stocks, you remain with the liquid assets, those which can easily be converted into cash within a short period of time. Then you now compare them with the current liabilities. So we normally say that is an acid test ratio, or it's a quick ratio. Okay, where you take the current assets, you minus stocks. The reason I've said is because some stocks may take a long period of time before they are sold. So to get a more clear picture whether your company is able to pay your current liabilities or not, you minus stocks. Get the more liquid assets, then you divide that by current liabilities. Now, this ratio, the standard, the recommended ratio should be 1:1. The recommended ratio should be 1:1. In other words, if you take your current assets, whatever they are, you minus current liabilities, you remain with 200 as your numerator. You have taken your current assets, you have minus stocks, whatever you got, I'm assuming is 200. If you divide that by current liabilities, which is maybe another 200, that will give you a ratio of 1:1. That is the recommended, the standard ratio. Okay? Therefore, we are saying whatever you get as your liquid assets, they should be the same as your current liabilities. They should be the same as your current liabilities. Good. Another liquidity ratio as number 3 is what we call the cash ratio. How do we determine the cash ratio? You take the cash of the business, cash of bank, you add what we call the marketable securities. You add marketable securities, and again you divide that by current liabilities. Again, you're trying to get a more liquid ability to pay your current liabilities. Listen, when I take cash or money in the bank, I add marketable securities. Listen, marketable securities which are under current assets. Remember, in your balance sheet, you may have stocks, debtors, cash or money in the bank. Then you have what we call short-term investment. Any investment among the current assets in the balance sheet. Listen, any short-term investment among the current assets in the balance sheet, that's what we call a marketable security, which is a security that can easily be turned into cash within a short period of time. Okay? This could include treasury bills. You know, treasury bills are bonds, are bills which can be sold and converted into cash maybe within 90 days, 180 something days, and so on. Good. So to get a more clear picture again, you can calculate what we are calling the cash ratio. You take the cash or money in the bank, whichever there is in the balance sheet, plus any short-term investment. Okay? This time you don't include debtors, you don't include stocks. Are you getting? You don't include debtors, don't include stocks. You are trying to get the most liquid assets, which is cash and money in the bank, plus any marketable or short-term securities or short-term investments. Then you divide that by current liabilities. So I'm through now with the first category of assets. With the first category of ratios. That's what we are calling liquidity ratios. Okay? Good. So before we proceed to the second one, or before we write down something concerning it, let me talk to some of you who are watching this. If you are watching this and you have not subscribed to my YouTube channel, please subscribe to my YouTube channel. You just go to the button down there for subscription. Click that subscription button. This will help you to be notified whenever we post new videos into the YouTube. You will be notified of the new postings. Okay? So click that subscription button so that you are notified whenever we post new videos into YouTube. Okay? If you have liked the class so far, please click that like button also. Click that like button to like the class. I hope you have managed to get something so far. Before we continue, click that like button. So just click the like button to like our video. Good. The other thing is for everyone now. This is for everyone. Now, tell your friends that we have online classes. Tell your friends that we have online classes for financial management of the intermediate level. Tell your friends we have financial management. We have online classes, financial management of the intermediate level. We also have financial reporting of the intermediate level. We also have online classes for advanced financial reporting of the advanced level. And we also have financial accounting of the foundation level. We have financial accounting of foundation level, or the one for ATD1 and ATD2. So tell your friends that we have online classes for those 4 subjects. One is the financial management of the intermediate level. 2, financial reporting of the intermediate level. 3, advanced financial reporting of the advanced level. 4, we have financial reporting of financial accounting, of the foundation level and of the ATD1 and ATD2. Okay? Now, in case your friends cannot be able to join live classes for these 4 subjects on any of them, then they can still buy what we call the pre-recorded videos. They can still buy what we call the pre-recorded videos, where they can watch the videos at their own free time. Sometimes one is not available to join the live class. If it's not available to join the live class, then he can buy what we call the pre-recorded videos, where he can watch the videos at his own free time. Good. For any one of them who is interested, or if you are here and you are interested in one of those subjects, you can call me on this number or text me on this number 0722 658875. 0722 658875. Okay? If you need the country code, then it will be 254 722. If you are using the country code 07254 722 658875. Good. So tell your friends they can call me on this number, can call me on that number 0722 658875. Then for more information. Okay, good. I think that's all I wanted to add concerning our online classes. Please subscribe if you have not subscribed. Like this video by clicking the like button. This is for everybody now. Then for your friends who have not joined the classes, then you can recommend them to join our online classes. That is for FM, financial management, financial reporting of the intermediate level, advanced financial reporting, and financial accounting. Then we have said if they are not available, join the live classes. They can buy the pre-recorded videos, and they can reach me in any one of the following number: 0722 658875. Good. So before we go to the second class of ratios, let's put down what we have discussed so far. Let's go back and now write a summary note on what we have already said since we began. So put down the topic. The topic is ratio analysis. Ratio analysis. Ratio analysis. Ratio analysis. Then you say this. Below that, topic is ratio analysis. Then you say this. Another subheading, uses of ratios. Uses of ratios. Uses of ratios. Uses of ratios. Number 1, uses of ratios. Uses of ratios. Number 1, to compare the performance. To compare the performance of different firms. Compare the performance of different firms in the same industry. To compare the performance of different firms in the same industry. Compare the performance of different firms in the same industry. But 2, another purpose, use of ratios. Another purpose or use of ratios. Say this. To compare, number 2, compare the performance of a firm. To compare the performance of a firm over a period of time. To compare the performance of a firm over a period of time. Compare the performance of a firm over a period of time. Good. That's the purpose of ratios. Now we can go to the next category or next subtopic, types of ratios. Types of ratios. Types of ratios. Let's quote them as they are. Number 1, the subtopic is type of ratios. Number 1, liquidity ratios. Number 2, activity/asset ratios. Number 3, profitability ratios. 4, gearing ratios. Number 5, shareholders ratios. 1, liquidity ratios. Number 2, activity/asset ratios. Number 3, profitability ratios. Number 4, gearing ratios. Number 5, shareholders ratios. If you're through, we start with the first category, and that is liquidity ratios. Liquidity ratios. Let's start with the first category. Liquidity ratios. Have that subheading. Liquidity ratios. Then you say this. These ratios measure the management's, with an apostrophe, these ratios measure the management's ability to repay its current liabilities. These ratios measure the management's ability. These ratios measure the Management's ability to repay its current liability, or the ability of a firm to repay its current liabilities. Good. Measure the ability to repay its current, the ability of a firm to repay its current liabilities. Then we can now quote number one. Number one, quote it there. Number one, current ratio. Then you quote the formula. Current ratio, then you quote the formula, is equals to current assets divided by current liabilities. Current assets divided by current liabilities. Let us say something below that. Let us say something below that. Then you say this. The standard or the recommended ratio, the standard or the recommended ratio is 2:1. Standard or the recommended ratio is 2:1. Standard or the recommended ratio is 2:1. i.e., current assets should be, current assets should be twice as much. Current assets should be twice as much as current liabilities. Current assets should be twice as much as current liabilities. Other paragraph. Any ratio greater than 1, any ratio greater than 1 means, any ratio greater than 1 means that the firm is able, any ratio greater than 1 means that the firm is able to pay its current liabilities. Any ratio greater than 1 means the firm is able to repay its current liabilities. Another paragraph. Any ratio less than 1 means, any ratio less than 1 means, any ratio less than 1 means that the firm is unable, any ratio less than 1 means that the firm is unable to pay its current liabilities. Any ratio less than 1 means that the firm is unable to pay its current liabilities. Next, another paragraph. Any ratio greater than 2:1, any ratio greater than 2:1, any ratio greater than 2:1 means, any ratio greater than 2:1 means that the firm is holding, too much funds. The firm, any ratio greater than 2:1 means that the firm is holding too much funds in current assets. Continue. These funds could be invested. These funds could be invested elsewhere to generate profit. These funds could be invested elsewhere to generate profit. Good. Another paragraph. This ratio is also known as, working capital ratio. This ratio is also known as working capital ratio. Some books will call it working capital ratio. Good. Let's go to number 2 now. Another type of ratio under liquidity. Andika number 2, acid test ratio. We also call it quick ratio. Acid test ratio or quick ratio. Acid test ratio or quick ratio. You can copy the formula. And copy the formula now. Saying the formula is acid test ratio equals to current assets minus stock, which is also inventory. You divide by current liabilities. Divide by current liabilities. You take current assets, you minus stocks. You divide that by current liabilities. Below that, you go ahead and say, the standard ratio is 1:1. Standard ratio is 1:1. Standard ratio is 1:1. Standard ratio is 1:1. Then from there you go to number 3, cash ratio. Cash ratio. You say this equals to, then copy that formula. Current as cash. Take cash, add the marketable securities, divide that by current liabilities. Marketable securities, you can even say stroke marketable securities stroke current investment. Current investments. Marketable securities stroke current investment. They are saying those are short-term investments. Okay? You take the cash, you add any current investments. Current investments. They are marketable securities. Divide by current liabilities. Good. I've discussed the first category. Now I want to go to the second category of ratios. Finish. I discussed the second category now. Okay. So we now go to the second category of ratios, which we have called activity stroke asset ratios. Let me introduce it again. We want to discuss the activity stroke asset ratios. Now, let me introduce them. First, we need to know what's the purpose of these ratios. Now, listen. As a company, you may want to know whether you as a firm, you are able to utilize your resources more efficiently. Resources include assets. So these ratios measure the management's efficiency in utilizing the available resources. That's the purpose of these ratios. To measure the ability of a firm to utilize the available resources. So they measure the ability of a firm in utilizing the available resources. Of course, the resources are in form of assets, of course. Okay? Let's go on. Now, let me start with the first type of ratio under this category. One type of ratio we shall be calculating under this category is what we call stock turnover. Stock turnover. That is stock turnover. And to get the stock turnover, we shall be getting it by taking the cost of sales. Whatever is your cost of sales as a company, we divide that by what we call the average stock. Take the cost of sales, you divide that by average stock. Listen, whatever answer you get, that answer should always be expressed in terms of times. It could be 2 times, 3 times, 4 times, and so on. Let me go on first. Now, when you take the cost of sales, you divide that by what we are calling the average stock. This ratio indicates to you as a company how many times, listen, how many times are you able to turn your stocks into sales? That's why we call it stock turnover. Or you can also call it inventory turnover. How many times as a company are you able to turn your stocks into sales? Okay? If, for example, company A as their stock turnover being 2 times, company B as their stock turnover being 3 times, obvious company B is better. Why? Because they are able to turn their stocks into sales more times than company A. Company A turns their stocks into sales 2 times in a year. Company B, they turn their stocks into sales 3 times in a year. Okay? So B is better. Good. So that's the purpose or the indication of this. How many times are you able to turn your stocks into sales? And we are saying you get it by taking the cost of sales, you divide that by average stock. Listen, to determine the average stock, get the average stock, we normally take the opening stock plus closing stock, you divide that by 2. That's how we normally get the average stock. Take the opening stock plus closing stock, you divide by 2. Good. That's the first ratio which we are using under activity ratios. It is a ratio that indicates to you how many times as a business are you able to turn your stocks into sales. And we are saying the higher the number of times, the better the firm. Okay? Good. That's one. Let me discuss the second one first before we put down the formulas. Let me discuss the second one. The second activity ratio is what we call debtors collection period. Debtors collection period. Debtors collection period. Or some books would call it trade receivables. You know, debtors are also called trade receivables. Let me explain. To get this ratio, you normally take debtors, the debtors of your business by the end of the year, you divide that by what we call credit sales per day. Don't write, I'll write that later. Listen, you take the debtors, you divide by what we are calling the credit sales per day. Whatever answer you get, that should be expressed in terms of days. In other words, how many days does it take you as a business to collect from your debtors? How many days does it take to collect debtors? Okay, listen. This formula can be expressed further. I have said, to get the debtors collection period, you normally take debtors, you divide by the credit sales per day. Now, this denominator, which we are calling credit sales per day, can be determined by taking, listen, it can be determined by taking credit sales for the whole year. You take the credit sales, you divide that by 365. We normally assume there are 365 days in a year. Okay? Now listen. Or you can put it this way. We divide this by 365. Don't try it fast. This same formula can be expressed as debtors. Remember, I've taken 365. It is the same as saying divide by credit sales. Don't write. I just want to derive something here. The same as credit sales. I've told you divide by what? 365. This formula can still be expressed mathematically to be debtors times what? Mathematically times what? Times 365. You divide that by what? By credit sales. You divide that by credit sales. Okay? That's another way you can express. Now, normally, listen, in an exam, when they tell you to calculate the debtors collection period, you don't have to derive this formula. I started by saying, get the debtors collection period, you take debtors, you divide by credit sales per day. That means it will give you the average sales per day. And I'm using, listen, we are using credit sales, not total sales. Because total sales include cash sales, and credit sales. But we are not looking for cash sales. Why? Because debtors don't arise when you sell goods by cash. Debtors only arise when you sell goods on credit. That's why we are associating the debtors with the credit sales, not with the total sales. Okay? But the final formula for determining the debtors collection period is this now. This is the final formula we shall be using. That to get the credit sales per day, you take the debtors, multiply by 365, you divide that by credit sales. And I've said, whatever answer you get, that should be expressed in terms of what? Days. Okay? I have said, this ratio indicates to you how many days does it take to collect from your debtors as a business. How many days does it take you, once you sell goods on credit, how many days will it take you to collect your money from debtors? Let me ask you a question. Suppose you calculate this ratio for company A and you find that they have a debtors collection period of 10 days, while company B have a debtors collection period of 30 days. Which company is better? Company A takes 10 days. Once they sell the goods, they take 10 days to collect from debtors. Company B, once they sell goods on credit, it takes them 30 days to collect from debtors. Which company is better? Which company is better? Is it company A or B? Is it A or B? It is obvious. Listen, it is obvious company A is better. Why? Because they are taking a shorter period to collect their money from debtors than compared to company B. Now listen, while me, company B, have already collected my cash, maybe both of us are to collect 2 million from our debtors. Me as a company A, I take 10 days and I get my 2 million. While you, company B, you have another 20 days to wait to collect your 2 million. Listen. So me, A, I can use it like my 2 million elsewhere. I can utilize my 2 million elsewhere to generate profit before you have another 20 days to get your cash. So we normally say, listen, the shorter the period, the better the farm. The shorter the period, the better the farm, because of different reasons. One, that company A is able to collect their cash earlier, and hence they can utilize it elsewhere, generate profit. You, company A, you have received your 2 million in 10 days. You can use your 2 million elsewhere to generate profit, while company B is still waiting for another 20 days to receive their 2 million. That's one reason why we normally say the shorter period, better farm. Another reason is this. Why the shorter the period, the better the farm. Now, you, company A, you give your customers 10 days to pay you. Company B gives their customers 30 days to pay them. The higher or the longer the period, listen, the longer the period you give your customers to pay you, the higher the chances they may not end up paying you. The longer the period you give your customers to pay you, the higher the chances they might not pay you. We normally say the longer the period, the higher the chances of bad debtors arising, as compared to the shorter the period, where the chances of bad debtors arising is low. Are you there? Good. That's another reason why we say shorter the period, better the farm, because there is a lower chance of bad debtors arising compared to when the period is long, where there are high chances of bad debtors arising. Good. That's our second ratio, under activity ratio. We have said to get what we are calling data's collection period. Data's collection period. How shall we be determining it? We have said it is data's times 365. You divide that by credit sales. And the answer you get, we have said, should be expressed in terms of what? Days. Okay? And I've said, what is the interpretation? Interpretation of this ratio is, gives you the number of days it takes to collect from debtors. Okay? Now we have said the shorter the period, better firm. Good. Before we go to number 3, let's put down those two first. Before we go to number 3, let's put down those two. So have another subheading, activity stroke asset ratios. Activity stroke asset ratios. Activity stroke asset ratios. Activity stroke asset ratios. Let's put down second category now. Activity stroke asset ratios. Then you say this. Under that, say this. These ratios measure. These ratios measure the management's, again with an apostrophe, these ratios measure the management's efficiency. These ratios measure the management's efficiency in utilizing the available resources. These ratios measure the management's efficiency in utilizing the available resources, stroke assets, of course. Utilizing the available resources, stroke assets. Then you can quote number 1, stock turnover. Stock turnover. You don't need to rub anything there. Just copy the formula. Don't need to rub anything there. Just copy the formula. We have said stock turnover is equals to cost of sales divided by average stock. Cost of sales divided by average stock. We have said whatever answer you get, you say equals to times. Whatever answer you get, you say equals to times. Then below there, you can say average stock. Average stock is equals to average stock. You can say equals to opening stock plus closing stock divided by 2. Average stock is equals to opening stock plus closing stock divided by 2. Then below that, before we go to number 2, we want to say something there. Under stock turnover, we want to say something. Under stock turnover, we want to say something there. Finish, we say something there. Say this ratio. This ratio indicates. This ratio indicates the number of times stock is turned, into sales in a year. This ratio indicates the number of times it takes to turn, or the number of times stock is turned into sales in a year. This ratio indicates the number of times stock is turned into sales in a year. Continue, another paragraph. The higher the ratio, the better the firm. Higher the ratio, better the firm. Higher the ratio, the better the firm. Higher the ratio, better the firm. That's number 1. Let's now go to number 2. Another efficiency ratio. Call it data's collection period. Data's collection period. I think you can copy that formula again. Data's collection period. You don't need to quote how it came down to this. You can just copy the final part. Data's collection period equals to data's times 365 you divide that by credit sales. And whatever answer you get should be expressed in terms of days. Debtors collection period equals to debtors 365 divided by credit sales. Answer you get equals to times. Good. Then let us see something below that. Let us see something below that. Put down this if you're through with the copying of the formula. You're through with the copying of the formula. Say this. This ratio indicates the number of days. This ratio indicates the number of days it takes. Number of days it takes to collect from debtors. This ratio indicates the number of days it takes to collect from debtors. To collect from debtors. This ratio indicates the number of days it takes to collect from debtors. Then you say this, top, the shorter the period, the better the firm. Shorter the period, better the firm. Shorter the period, the better the firm. Shorter the period, the better the firm, since shorter the period, the better the firm, since the business can receive cash earlier, since business can receive cash earlier, and hence, since the business can receive cash earlier, and hence utilize it elsewhere, and hence utilize it elsewhere to generate profit, and hence utilize it elsewhere, generate profit, and hence utilize it elsewhere, generate profit. Another paragraph. Also, the shorter the period, the lower the chances of bad debtors arising. Also, shorter the period, the lower the chances of bad debtors arising. Also, the shorter the period, the lower the chances of bad debtors arising. As compared to the longer the period, as compared to the longer the period, where as compared to longer the period where there are high chances, of bad debtors arising, where there are high chances of bad debtors arising. Good. So we are through with that ratio number 2. Let me go to number 3 now. Another activity ratio is what we call, number 3, is what we call creditors collection period. Creditors collection period. Let me explain it. Almost related to debtors collection period. Listen. This again is determined by taking creditors. You divide that by credit. Don't write credit purchases per day. You take the creditors of your firm, you divide by credit purchases. We are not dividing by total purchases because cash purchases don't give rise to creditors. It's only credit purchases that give rise to creditors. That's why we are dividing by credit purchases. Again, this can be expressed as creditors. We divide that by credit sales, credit purchases. We divide that by 365. This mathematically can be expressed as, okay, it can be expressed as creditors times 365. You divide that by credit purchases. Again, the answer you get should be expressed in terms of days. Okay, that is what we do to determine what we are calling the creditors collection period. Creditors collection period. Now listen again. Let me give you an illustration. You conclude for me. We have two companies now, A and B. Listen, you are a creditor. You as a company, you can buy your goods on credit from company A, or you can buy your goods on credit from company B. Now listen, company A tells you, if you buy goods on credit from us, we allow you 20 days to pay us. Company B says, if you buy goods from them, they will give you 40 days to pay them, or let's say 60 days to pay them. You as a company, where will you buy your goods on credit? Will you buy goods from company A, or will you buy goods from company B? You are a company, you are looking for a supplier to supply goods to you, so you want to purchase goods on credit. Company A tells you, if you buy goods from us, we normally give our customers 20 days. B tells you, if you buy goods from them, they give their customers 60 days to pay them. Will you buy goods from company A, or will you buy goods from company B? Obvious. Listen, you will obviously buy goods from which company? B. Why would you buy goods from company B? And in other words, why are we concluding that the longer the period, the better the farm? Why are we concluding that the longer the period, better the farm? Again, listen, for two reasons. One, if you buy goods from company B, they have given you enough time. You as a company, they have given you enough time to make arrangements for payment. That's one. But the longer the period, the better the farm, because you are saying this gives the company enough time to make arrangements for payment. That's one. Two, the longer the period, better the farm, because look at company A. Company A have already paid by the 20th day. They have already paid their 2 million to the supplier. You, company B, you have another 40 days to do what? To utilize your 2 million elsewhere to generate profit before the date of payment comes. Okay? You have another 40 days to go to use your money elsewhere before the payment date comes. So the longer the period, the better the farm, because we are saying you, company B, you have, or you can utilize your cash elsewhere. You can utilize your cash elsewhere to generate profit before the date of payment. Those are the two reasons why we are saying the longer the period, the better the farm. One reason is you are given enough time, make arrangements for what? Payment. Two, you company B, no, you as a company, you are given another 40 days. Utilize your cash elsewhere, generate profit before the date of payment. That's why we normally conclude the longer the period, better the farm. Let's put down that number 3 now. Let's put down that number 3. You don't need to copy again everything on how it came about. Just come and see your number 3. Creditors collection period, creditors collection period, creditors collection period. Then you copy that formula is equals to creditors times 365. You divide that by credit purchases. And the answer you get should be expressed in terms of days. Answer you get should be expressed in terms of days. Good. Then we want to say something below that. Want to say something below that. Finish, we say something below that. Finish, we say something below that. This ratio indicates the number of days it takes, to pay creditors. This ratio indicates the number of days it takes to pay creditors. This ratio indicates the number of days it takes to pay creditors. You say this, the longer the period, the better the firm. Longer the period, better the firm. Longer the period, better firm. Since longer the period, the better the firm. Continue. Since one can utilize cash elsewhere. Since one can utilize cash elsewhere to generate profit. Since one can utilize cash elsewhere to generate profit before the date of payment. Since one can utilize the cash elsewhere, generate profit before the date of payment. For the date of payment. Another paragraph. Also, the longer the period means that one is given enough time. One is given enough time to make arrangements for payment. One is given enough time to make arrangements for payment. One is given enough time to make arrangements for payment. One is given enough time to make arrangements for payment. Okay? Let's go now to next one. Let me now go to number 4. The fourth ratio under activity is what we call fixed assets turnover. Fixed assets turnover. How do we get it? Fixed assets are also called non-current assets. Okay, I know you know that. You may be told calculate the non-current assets turnover or fixed assets turnover. We get it by taking sales divided by fixed assets. Sales divided by fixed assets. Now let me explain it first. Let me explain it. Your sales as a company is 20 million. Your non-current assets or your fixed assets are 2 million. So you get a ratio of how much? 10. What does that 10 indicate? Listen, your sales are 20 million. The beer, your fixed assets were 2 million. Now, this ratio tells me, listen, how much are you as a firm able to generate? How much are you able to generate as sales from every shilling invested in the fixed assets? From every shilling you have invested in your fixed assets, how much are you able to generate as sales? So in this company, they are able to generate 10 shillings as sales from every shilling invested in fixed assets. Another company, let's call it, this is A. B, their sales are 50 million and their fixed assets were 10 million. How much are they able to generate as sale from every shilling invested in the business? How much? 5 shillings. Which firm is better? In other words, which firm is able to utilize its available resources, we are calling fixed assets here? Which one is able to utilize their resources more efficiently? Is it A or B? Company A, from every shilling they have invested in their business as a fixed asset, they are able to generate 10 shillings as sales. Company B, for every shilling they have invested in the business as a fixed asset, they are able to generate 5 shillings as sales. Which company is better? It is obvious company A is better. Okay? Though the sales of company A, B are more, though the fixed assets of company B are more, but we are not looking at the magnitude of their sales or their fixed assets. We are looking at the ability to utilize the available resources. So for every shilling company B is putting their money into fixed assets, that fixed 1 shilling is able to generate 5 shillings as sales. Company A, for every shilling they are putting their money in a fixed asset, that 1 shilling is able to generate 10 shillings as sales. So company A is better. That's the indication of this ratio. That is the indication of this ratio. How much you as a company you are able to generate as sales from every shilling invested in the business as a fixed asset. I've said the higher the ratio, the better firm. The higher the ratio, the better the firm. So let's put down that number 4. Put down that ratio of 4. Fixed assets turnover. Fixed assets turnover. And you put down the formula is equals to sales divided by fixed assets. Take it as sales, divide that by fixed assets. Take sales divided by fixed assets. Below that this ratio indicates, this ratio indicates how much, this ratio indicates how much a firm is able to generate, as sales, how much a firm is able to generate as sales from every shilling invested as fixed asset. Every shilling invested as a fixed asset. Every shilling invested as a fixed asset. And you see this, higher the ratio, better the firm. Higher the ratio, better the firm. Higher the ratio, better firm. Good. We now move on to number 5. Let's move on now to number 5. Another activity ratio of 5 is what we call total assets turnover. I think now you can give me the formula. When we now say total assets turnover, it's obvious. It would be sales divided by total assets. Put down this formula. That one we don't need to interpret it again. Having interpreted the total assets, then fixed assets, same implication. For every shilling you're investing in your business as an asset now, not as a fixed asset, as an asset, how much are you able to generate as sales? That's the interpretation of that ratio. Copy that formula. 5, total assets turnover equals to sales divided by total assets. Good. Number 6, debtors turnover. Debtors turnover. What do you think should be the formula now? Debtors turnover. What do you think should be the formula? Debtors turnover. What do you think should be the formula? Listen. Now I don't just use sales. Why? Because not all sales bring about debtors. So you can be told to calculate what we call trade receivables turnover. We are also calling it debtors turnover. You know, trade receivables is also known as debtors. Okay? Good. So again, now we use credit sales, not just total sales. It's credit sales. You divide by debtors. You take credit sales, you divide by debtors. Good. That's our ratio number 7. Number 6. Let's go to number 7 now. Copy number 6. Then we go to number 7. Number 7, put it down. Creditors turnover. Creditors turnover, which we can also call trade payables turnover. How do you get it? How do you get it? Now you know what brings about creditors. What brings about trade payables or creditors is only what we call credit purchases. Take credit purchases, you divide that by creditors. Take credit purchases, divide that by creditors. Next, number 8, stock holding period. What do you think? Stock holding period, it's related to debtors collection period. You remember, it was related to creditors collection period. So the formula now is we are dealing with stock, not debtors. You remember here, listen, let me just relate it to you. When we were calculating debtors turnover, we said it's what? When we were calculating debtors turnover, I gave you the final formula here. I said it is debtors times 365. You now divide by credit sales. Okay? Now, when you are calculating stock holding period, how long does it take you to hold that stock before it's converted? You take the stock, multiply that by 365. We are taking stock, whatever is the value of the stocks, times 365. Listen, this time you don't just divide by sales. You now divide by what we call cost of sales. What brings about closing stock? It's the purchases, the cost of sales. Now you divide by the cost of sales. Put down that formula number 8. We are calling it stock holding period. Then you say something below that. You remember debtors collection period was how many days it takes to collect from debtors. Creditors collection period was how many days it takes to pay creditors. Now put down the interpretation for this one. Put down the interpretation for this one. This ratio indicates the number of days. Go back. The formula should be expressed in terms of days. The formula should be expressed in terms of days. I forgot to mention equals to days. So same IV. This ratio indicates the number of days. This ratio indicates the number of days. Stock. This ratio indicates the number of days stock is held. Number of days stock is held in the warehouse. the number of days its stock is held in the warehouse before being sold. Before you sell your stocks, how long does it stay in the warehouse? Maybe 20 days, 30 days. That's what we are calling a stock holding period. Okay? The stock holding period indicates how many days it takes to hold your stock before it is sold. Okay? So those are the activity ratios. Those are the activity ratios. Okay? So I want to stop there for today. I'll pick it from there next time when we shall now go to the next class of ratios. And our next class of ratios is what we call the profitability ratios. Then after profitability, we go to next ratio was which class? Gearing ratio. Then after gearing, we said which is the next class of ratios? Shareholders ratios. Once we have gone through all of them, then we shall now do some few past paper questions. Okay? Good. So before we conclude, let me remind you what I had requested you. If you are watching this and you have not subscribed, please subscribe to my YouTube channel. Just click that subscription button down there. And once you click it, you will be notified whenever we post new videos into the YouTube. Okay? Good. The other thing I said, please like the video. Click that like button to like the video. Click that like button to like this video. Okay? The other thing I said, if you have friends who are looking for online classes, tell them that we have online classes for financial management of the intermediate level. We have financial reporting of the intermediate level. We have advanced financial reporting of the advanced level. And we have financial accounting of the foundation level, and the one of ATD1 and ATD2. Okay? Then I said, if the friends can't join the live class in any of these classes, then we said they can buy what we call what? The pre-recorded videos. They can buy the pre-recorded videos and watch the videos at their own free time. Okay? Any of these four subjects. Then I said for more information, they can call me on 0722 658875. 0722 658875. Good. That's all for today. We can stop there for now. Pick it up from there next time, where we shall now proceed with the remaining categories of ratios. Bye for now. See you next time.